Slide 5. The stock market, S&P 500, is a basket featuring 500 of the largest US exchange-listed companies. It serves as a reliable proxy for aggregate stock performance in the United States. This index is what people often mean when they refer to the stock market. The companies in the S&P 500 operate across many different sectors and industries. It's an excellent starting point for new traders. There's currently 503 constituents in the S&P 500. These are highly liquid, large-cap stocks that uphold rigorous reporting and investor relations standards. A stock index represents the broader stock market of a nation or economic zone. Index futures and exchange-traded funds can be bought and sold directly or used as a reference in analysis. The S&P 500 is the most liquid stock market index in the world. Trading the index involves less microeconomic risk than investing in specific sectors, industries, or individual companies. As the index represents stocks on aggregate, returns are also generally less volatile due to the inherent diversification of the index in comparison to individual companies' stock returns. Chart: Annualized GDP growth versus S&P 500 annual returns. Stocks correlate with GDP. On a year-over-year basis, these fluctuations in economic activity are known as the business cycle. When GDP expands, stock returns are typically positive. When it contracts, returns often turn negative. The cycle moves through peaks and troughs, shifting from growth to contraction. Our goal is to capitalize on this relationship by trading the macroeconomic trends. Traditionally, a recession is defined as 2 consecutive quarters of negative annualized GDP growth. The key takeaway here is the timing. Stock returns act as a leading indicator, anticipating change, while GDP is a lagging indicator, confirming change. As traders, our job is to forecast what the economic future looks like and position our portfolio for that reality today. Essentially, we are looking to directionally predict the path of GDP. Later, we will look into the economy in far more depth. Slide 6. Betting on a price rise. This is the position to take when you believe the price of an asset will rise in value. If the asset rises in price, you make money. If it falls, you lose money. This transaction is facilitated by a regulated investment broker. Buying has unlimited upside and limited downside, as a stock can only drop to $0, but in theory it could rise to infinity. Betting against a price rise. This is a position you take when you believe the price of a financial asset will fall in value. If the stock rises in price, you lose money. If it falls, you profit. This transaction is facilitated by a regulated investment broker. Short selling has limited upside and unlimited downside, as a stock can only drop to 0 but could theoretically rise to infinity. Betting on outperformance. A pairs trade is a market-neutral strategy involving the simultaneous purchase of one asset and the short sale of another. This allows traders to hedge against broad market volatility, for example. One might go long on Domino's, DPZ, and short Papa John's, PZZA, if they believed Domino's share price will outperform its competitor regardless of overall market direction. Chart: S&P 500 daily close. As we can see, the stock market trends upward or downward depending on broader economic conditions. When the economy is expanding, stocks generally trend higher. When there is uncertainty or contraction, they trend lower. Over the long term, the S&P 500 has a strong upward bias, averaging a return of roughly 9.88% per year since 1993. However, it is rarely a smooth ride. During periods of high uncertainty, volatility spikes and markets can sell off with extreme speed. We saw this during the 2008 global financial crisis and the 2020 COVID-19 crash. Understanding this upward drift versus short-term volatility is the first step in mastering market psychology. Tool. Now we can revisit a concept I mentioned earlier, spread trading, or betting on the relative outperformance of one stock versus another. To see how this trade is visualized, return to the 03_getting_started spreadsheet and navigate to the links sheet. In cell B3, click the Charts link. In the search bar, type DPZ/PZZA. This creates a ratio chart. When this ratio is rising, it means Domino's DPZ is outperforming Papa John's PZZA. Traders use the pair's trading strategy to hedge out broader market or sector risk, focusing purely on which company is the stronger runner. Long-short spread trading, Domino's versus Papa John's. As the chart illustrates, Domino's has historically outperformed Papa John's over the long run. Recently, the spread has been range-bound with significant volatility. While we highly recommend spread trading for its risk management benefits, we only cover it briefly here, as it can be fairly complex for beginners. The key takeaway: you don't always need the market to go up to make a profit. You just need to pick the faster horse. Let's explore a new concept: stock screening. This is how professional traders filter through thousands of companies to find specific opportunities. Return to the 03_getting_started spreadsheet and navigate to the links sheet. In cell B2, click the Stocks link to open the screener. To focus our search, we will apply a filter to show only S&P 500 constituents. Go to the Filters drop-down, select the Descriptive tab, and set the index filter to S&P 500. Tool. We now have a targeted list of the most influential companies in the US. FinViz is an incredibly powerful tool that allows us to rank stocks based on both quantitative, data-driven, and qualitative, characteristic-driven fields. To visualize recent market movement, click the Maps or Tickers tab and select Perf Quarter, Quarterly Returns Performance. This generates a heat map where block size represents the market cap, the total dollar value of the company. Larger blocks like Apple or Microsoft indicate they carry more weight in the index. Color indicates the stock return. Bright green represents high positive returns, while bright red indicates significant losses over the quarter. This view allows you to instantly spot which sectors or companies are leading the market and which are lagging. Presentation 05_company_fundamentals. Now let's cover basic company fundamentals. We will focus primarily on valuations, learning how to quickly compare stocks relative to one another. Valuation multiples and growth rates are the most common tools for this. Let's walk through the presentation. 05_company_fundamentals. Slide 1. Price to earnings ratio. The PE ratio is the most commonly used valuation metric in the stock market. A company trading at a PE of 10 can be read as the price is 10 times earnings. A low PE stock trading at a discount to its industry and sector is usually a signal the market doesn't like the company in comparison to the competitors trading at a relatively higher PE, as it is a comparable metric, allowing us to rank net profit-making companies in terms of how much the market values the company's earnings. The PE formula equals price per share divided by earning per share, or the market cap divided by the net income, trailing 12 months. When it comes to stock valuation, don't argue with the market. The hive mind is smarter than an individual. Just because the PE ratio is low does not mean the company is cheap. The valuation could get cheaper. The low valuation likely reflects a belief that earnings will drop in the future. A high PE would be tolerated if we believe the earnings of the company will grow significantly over the next 12 months. Price to sales ratio. The price to sales ratio is a commonly used valuation metric used by participants in the stock market. A company trading at a P/S of 5 can be read as the price is 5 times sales. A low P/S stock, trading at a discount to its industry, usually signals the market does not like the company in comparison to its competitors trading at a relatively higher price-to-sales valuation. P/S is a comparable metric, allowing us to rank revenue-generating companies in terms of how much the market values the top-line income before costs, expenses, interest, and taxes are deducted. The P/S formula equals price per share divided by revenue per share, or market cap divided by revenue. Don't argue with the market. The hive mind is smarter than any individual 80% of the time. Just because the P/S ratio is low does not mean the company is cheap. The valuation metric could get much cheaper. A low price/sales valuation likely reflects a belief that sales will drop in the future. A high PS would be tolerated if we believe the revenue or earnings of the company will grow significantly over the next 12 months. Income analysis. Sales mix is the percent share of each revenue source for the business. We can assess how the company earns income, what products, business segments, and geographies the company's earnings have exposure to, and how the segments have grown over time. Earnings growth is the percent rate at which earnings are estimated to grow over a specified time period, next 12 months, next 24 months, next 36 months. Companies which can sustainably grow their earnings command premium valuations. Companies which are not growing or are underperforming command a discounted valuation. Sales represents the income before any costs and expenses are deducted. We use this alongside earnings growth as a head check to where the estimated earnings growth is coming from. As stated previously, when a business is a startup or early stage, it may not be appropriate to look at profits, as they likely don't have any yet. Instead, we will concentrate on sales. The market capitalization, representing the total dollar value of equity for a company trading on the exchange. To calculate the market cap, we get the share price and times it by the total number of shares. The actual share price is insignificant, as you could have Company A, which has a market cap of $10 billion, but trading at $100 per share, 100 million shares. Company B with a market cap of $10 billion, but trading at $1,300 per share, 7,692,308 shares. They both have the same market valuation, $10 billion US. However, the share price is vastly different. All this means is Company A shares represent a smaller percentage of ownership when compared on a share-for-share ownership basis. Companies listed on US exchanges must register and file with the Securities and Exchange Commission. They regulate companies and their financial reporting. Common documents regularly filed by companies include 10K Fiscal Year-End Financial Report, 10Q Quarterly Fiscal Report, 8K Current Report. We can find a wealth of information in these documents, and it helps us understand the microeconomics of specific companies and industries. Understanding how to read these documents is important. All it takes is some basic accounting knowledge and application of common sense. This concludes our look at valuations. Your goal is to use screeners to find interesting candidates for your fundamentally driven trade ideas, then dive into these metrics to see if the market's valuation is justified. These tools are your primary way to compare apples to apples in the world of fundamental stock analysis. Slide 7. Stock market G, ICS sectors and industries. Market sectors represent the broader industries of a nation or economic zone and can be traded or used in analysis. Cyclical assets are highly sensitive to economic demand. Defensive assets are less sensitive to economic demand, providing a safe haven when economic growth slows. Now let's look at how we categorize stocks to connect a company's operations to the broader macroeconomy. At a broad level, we divide the market into two main categories, cyclical and defensive, also known as super sectors. Category A. Cyclical sectors are highly sensitive to macroeconomic growth. These businesses rely on strong consumer demand and a healthy economy to thrive. Sectors include consumer discretionary, financials, real estate, basic materials, energy, industrials, and technology. Category B. Defensives. Defensive stocks are less sensitive to the economic cycle. They provide necessity products and services that people buy regardless of how the economy is doing. Sectors include communication, consumer staples, healthcare, and utilities. It's critical to note that communication services is often considered a hybrid. While it contains necessities, like internet providers, it also includes discretionary areas like media and advertising. Industrials and technology are somewhat the same. Trading via ETFs. Each sector has a corresponding exchange-traded fund. These highly liquid funds invest in S&P 500 companies within the specified sector. Using ETFs allows us to trade broad economic themes without having to pick individual winning stocks. Let's look closer at the XLY constituents, the consumer discretionary sector organized by size. Take note of the companies listed. You will likely recognize many of them, as they provide the goods and services people spend their disposable income on when they feel financially secure. We will compare these companies on a price-to-earnings basis, looking for the stocks with the most premium valuations. Take note of the various industries in this sector. Slide 8. Stock market, styles and themes. Market styles represent the overarching investment themes of a nation or economic zone. Individual names, specific companies within these styles that can be traded or analysed. Secular trends. Long-term thematic shifts that drive market behaviour regardless of short-term economic cycles. Now let's categorise the market further by looking at style factors and investment themes. Size, market cap. We categorise companies as large, mid or small cap based on their total valuation. Valuation, growth versus value. Growth stocks trade at a premium because of future potential, while value stocks trade at a discount relative to their current fundamentals. Quality. This refers to a company's financial health, such as low debt and consistent profitability. Price action. Momentum and low volatility. Momentum focuses on stocks already trending higher, while low volatility targets stocks with steadier, less erratic price movements. Income. Dividends. This identifies companies that regularly return a portion of their earnings to shareholders. Let's apply this to a real-world example, the artificial intelligence AI theme. Because AI is an emerging industry, many smaller companies are not yet profitable. To find the interesting stocks in this space, we can filter for the small cap style factor and then sort by price to sales, PS. This allows us to see which small cap AI companies the market is currently valuing at a premium based on their top line revenue growth. Let's tie everything together. We will shift our style filter from small cap to mid cap. Mid cap companies, valued between $2 billion and $10 billion, generally offer a balance of growth potential with less extreme risk than small caps. Next, we will clear the AI theme and focus on the consumer electronics industry within the technology sector. This reveals the heavy hitters: Apple, AAPL, LG, and Sony. Apple Inc. is the undisputed leader here. Let's dive deeper into Apple by clicking its ticker symbol. Surface level metrics. Before looking at the price chart, we must understand the business. The summary table provides vital, comparable metrics. AAPL is a cornerstone of the S&P 500, Dow Jones, and Nasdaq 100. Apple has been a public company since December 1980. Monthly performance. This shows the stock's return over the last 30 days. Note, if you are unfamiliar with a metric, hover over the title for a definition. Researching all these terms independently is great extracurricular work. Revenue and sales mix. To understand where the money comes from, click the Financials tab, then Revenue. Analysing the last 10 years of data reveals iPhones account for roughly 50% of total sales. Services account for roughly 25%. Other products such as Macs, iPads, and wearables each represent less than 10%. The United States represents just over 1/3 of total sales, making Apple a truly global business. Analyst estimates, the forward look. Now let's see what Wall Street expects for the future. Navigate to the Earnings tab and select the annual time frame. Blue bars, the actual reported earnings per share, EPS. Grey bars, what analysts forecast the EPS to be. The forecast. Looking ahead to the next fiscal year. April 2026, this estimate is less important than April 2027, as we are currently in March 2026. Current earnings is too close to matter unless there's significant surprise, which is historically uncommon for this business. We want to see if the growth is accelerating or decelerating. Apple is projected to grow positively at an increasing rate over the next few years. This acceleration is often what drives share prices higher. Finally, let's verify our assumptions. What exactly is Apple's service revenue? By visiting Apple's investor relations page and opening their latest 10K annual report, we can search Ctrl+F for services. It turns out it's much more than just the App Store. It includes advertising, AppleCare, iCloud, digital content, music and TV, and payment services, Apple Pay. This level of detail is the difference between a guesser and a researcher. Your job is now to repeat this process for other companies, finding those with the strongest fundamentals and upcoming catalysts to trade on. We will learn more about stock market catalysts in the trading module. Summary. The stock market represents company shares, stocks, equity, or shares, that trade on a particular exchange or are listed within an economic region. The primary stock market index in the world is the S&P 500. This index represents 500 of the largest companies in the USA, the world's largest country by GDP. These companies and their financial results form the backbone of the economy. We can further categorize companies into sectors, industries, and styles. By comparing these entities, we can identify stocks likely to rise or fall in price. We have discussed the various positions available and how to profit in both bull and bear markets. Key points. A stock index is a basket of companies' shares. Comparing cyclical sectors versus defensive sectors. Industry level. Comparison, market capitalization, price to earnings, price to sales, price to free cash flow, earnings growth, return on invested capital, and margins. Company-level fundamentals, income statement analysis and analysts' estimates.